Hey everyone, welcome to the Wealth and Wisdom podcast where intentional planning meets eternal perspective. It is Monday, August 5th, 2025, and we're so glad you're here. I'm Cole Leonida, and I'm joined by Brian Cochran. We are part of John Moore Associates, a financial planning firm serving successful and generous families across the country. So what we're looking at today is that the market finally had a down week. We had a really spectacular run in the market for the past few months since the tariff tantrum that the market put in, and then the market just continued to push higher. And what caused all of that? Well, we had just a slew of economic data that came out. We also had a Fed meeting. So I'm going to run through some of the data that we got, as well as the big decision by the Fed to hold rates. We just talked to our bond manager this morning, who's just an incredible part of our investment committee. And he shared with us that if he was on the Fed committee, he certainly would have voted with the two dissenting votes to potentially cut rates last week. But now we'll have to wait until September to see what the Fed is going to do. Again, they held rates to exactly where they've been. And what we're looking at now is we're looking at September, a potential for a 25 basis point rate cut, or a 1/4%. And what we're thinking is that in September, it could be a little bit too late, which a lot of people give the Fed a hard time for that. But the bond market specifically, is pricing in a 25 basis point rate cut with a 90% probability of that happening. Now, the bond market's been wrong before. We've seen those percentages before, but it is noteworthy that it went from about 40% probability and then it went to a 90% probability. And what was the catalyst for that? Well, it was some of the economic data, particularly the jobs data last week. Last week, we saw only 73,000 new jobs on the non-farm payroll print. That was well below expectations, as well as well below the monthly average over the last several years. Potentially even more noteworthy, Brian, was the fact that we saw a downward revision of about 250,000 jobs for the previous 2 months. So not only did we get a disappointing jobs number for the most recent month of July, but we got revisions for the previous 2 months as well, which gives us an average monthly job gain of only about 35,000 jobs. That is not enough for a growing economy, and we've seen some cracks in the labor market up to this point, though it hasn't really materialized into anything. So with that, is there anything that you would add from an economic data perspective that people should be looking out for?
Yeah, there's just so much going on, as you said. Last week was sort of seemed like a pinnacle of just months and months of growing uncertainty and new data coming through. And what we're seeing is there's a lot going on both key fronts of fiscal and monetary. So the fiscal side is, what's the government doing? Are they borrowing? Are they spending? How much are they borrowing? How much are they spending? Are they cutting taxes or raising taxes? And now we're seeing on the monetary side, that's the Federal Reserve, are they growing their balance sheet, shrinking their balance sheet? Are they raising rates or cutting rates? So tons of news on both fronts. And you covered the monetary side well, Cole, with that increased probability of a September rate cut, which is going to have ripple effects through the economy and how the bond market's already responded. On the fiscal side, what we're just starting to get a sense of is some of the stimulus from the One Big Beautiful Bill Act. Well, it's always a mouthful, isn't it? The One Big Beautiful Bill Act.
Leave it to Trump, right? Leave it to Trump.
Yeah. Oh, it's got to have a great title. So that bill obviously passed through and is now law, but we haven't really seen the economic ramifications. But there was a great article this morning, Wall Street Journal article, that mentioned that we're starting to see forecasts of how much tax savings is actually going to come through to corporate America. So we did a great video. I say it's a great video because I was in it, but Andy Ferguson, our other planner, and I did a video breaking down some provisions of the One Big Beautiful Bill and how it impacts families and households. But what we're seeing on the corporate side is some pretty big numbers. So the article cited AT&T as an example, saving over $1 billion of taxes. Now, I would note these tax savings aren't just thrown to the companies. They are the result of tax savings in the areas of research and development, as well as significant investments and accelerated depreciation around things like big equipment purchases and real estate. So you see those coming through only if the businesses are investing. But when you look at some of the really big companies that have been driving the market, companies like Meta, Facebook, Amazon, Apple, Alphabet, Alphabet's looking at about a $17.5 billion tax savings. Amazon, 15 plus billion, Microsoft over 10 billion. So these are huge dollar amounts coming back to the corporations. And what they will likely do with that is spend it. Honestly, they'll turn around and spend it on additional investment. They can use it on stock buybacks, which helps the market move forward. So some of the positives from the One Big Beautiful Bill Act are maybe just starting to appear and could be influential, but it adds to that uncertainty and volatility we've seen in the markets that no one really knows for sure how this will all play out yet. It's just a lot of change in a short period.
Yeah, it has been a lot of change, and the market has been overwhelmingly positive about a lot of the change. And we've seen earnings season be, again, exceptionally positive for the most part with companies. We've actually seen a couple of companies where they're beating earnings and they're raising guidance, and yet the market is penalizing them, or at least they did last week, maybe because they didn't raise guidance enough or they didn't beat by enough. So it's an interesting time to be an investor. And what our committee's been seeing, Brian, is we're seeing some pretty high prices for stocks. Valuation stocks have been pretty expensive for the better part of the last couple of years, but they just continue to get more expensive. Can you explain a little bit about some of the way that we measure valuation?
Yeah, so when we measure valuation, we look at the current interest rate environment because interest rates influence how much you're willing to pay for a company. We look at the earnings growth forecasts of the S&P 500 as a whole, but also as individual companies. And we kind of try to get a sense, are people paying too much for those forward or those expected earnings? And as you said, we've seen those numbers reach pretty close to all-time highs. We're not back to 2000 tech bubble levels, but we're at very high levels, the highest we've seen since then. I would note, though, last week between the stock market dropping and interest rates dropping, both of those factors move our valuation metrics down. So actually, those stocks still look relatively expensive by our view and by our measurement. They are a heck of a lot cheaper than they were the last several weeks. So maybe things are moving the right direction with this recent market downturn, and if rates continue to slide a little bit through the end of the year, could make stocks look more attractive, which could move some money back towards the market. So again, just all this tension, all these forces moving back and forth and pushing and pulling against each other probably means more volatility ahead as well.
Yeah. One place where we've seen volatility slide pretty dramatically, which is a good thing, was in the bond market. We've seen the volatility index on the bond market, called the move down rapidly over the last couple of months. Any insight that you think would be helpful on what we're seeing on the bond market, maybe short term versus long term, and kind of how the Fed plays into that?
Yeah, I'm just encouraged by any upward movement in bond prices because the last few years has been terrible for bonds. And we've seen some clients come in and say, get these bonds out of my portfolio. They don't do anything. They're not helping. So maybe with interest rates moving downward again, even if we get stock market volatility, maybe bonds will serve their traditional purpose in providing a cushioning or a inverse correlation to the market, where market's down, bonds are up. That's what happened on Friday. More of that would be nice when we see stock market volatility. But it reminds us to look for bonds not for high appreciation, but for preservation and security. So time will tell with the bond market how much they're going to really see a price bounce back. But if we can at least get 3 to 5% total return from our bonds, which is what we're on track for many parts of the bond market this year, boy, that would be a nice boost to our overall portfolios, who have really seen nothing but headwinds from bonds for 3-4 years now.
Yeah, it certainly would. And, we've gotten to watch diversification play out. And one of the ways that we've seen that is we do have some precious metals exposure for certain pieces of our portfolio or different models that we manage. And boy, that's been a really strong performer this year, particularly with gold. So the idea of not putting all your eggs in one basket, you never know when the growth-oriented stocks might go out of favor, or there might be there's a lot of headline risk out there now, especially as you're saying, kind of we're getting some positive coming out of the big beautiful bill that could be a bit of a tailwind for some of those big tech companies. It just as easily can go the other way, especially with tariffs still being in play. We saw a lot of movement on tariffs last week, and there's kind of a floor raise, but also some deals that are coming in. It's just a highly fluid market. And one thing that I think has been really noteworthy that we've been paying attention to is the flow of assets. A lot of the automatic purchasing through 401ks and ETFs and passive investing that's really risen over the last 10 years has been really fascinating to watch, because there's just been kind of forced flows into a lot of those big tech companies. And the bigger they get, the more money that gets forced to be bought in those in things like target date funds or some of the indexed ETFs. So it'll be really interesting to see how the dynamics shift as potentially unemployment rate starts to climb. We saw that tick up this past month. So what we've been seeing is over the last several years since COVID, we've seen way more jobs open than people seeking them. So it's been a imbalanced market. And just recently, we saw that flip, where there's actually more people looking for jobs than jobs available, which again is another sign that the labor market might be slowing down. There's some cracks. We're seeing unemployment start to tick up. So if we see fewer people employed and we see less money and fewer people making those contributions into okay, I've got to be curious, what is that going to mean for those mega cap, Mag 7, Mag 8 type names? Time will tell, but I think that the idea of staying diversified is a principle that we, frankly, have been a little bit penalized for, Brian, the last few years, because it's just been so concentrated in the large, growth-oriented stocks. And now perhaps we're seeing a shift towards diversification starting to benefit in terms of total return. What do you think on that?
As someone who preaches diversification all the time, I'd like to see it return to favor because it's been called de-worsification recently because being diversified has actually been a negative for your portfolio. I mean, time will tell, and that's one of those areas I think when we think of takeaways for people watching this, people listening is, the diversification, don't give up on it because there's still a lot of value. We talked about the market looking expensive. That's true of the overall market and the large cap, but the small and mid caps still look relatively inexpensive. If you've been giving up on your bonds, maybe they're going to fall back in favor here in the coming months and years. So there's a lot here that as these tides turn, as the market shifts, some of the trends that have been so strong the last several years could pivot and fall out of favor. So diversification's big, whether it's owning different types of stocks or owning stocks and bonds, and as you mentioned, other assets such as alternatives and precious metals. That's a big one. What are you thinking, Cole? We talked about this a little bit in our committee for short-term savers. We talked about with the interest rates going down, does that mean your online savings and your bank accounts are going to drop too? And then what do you do about that?
Yeah, it's a good question. One thing I'd add to you mentioned small and mid cap names. I heard this morning that the small and mid cap stocks are still 11% off their all-time highs that they put in back in 2021. So you talk about things going in and out of favor and buying things on sale. Small and mid cap names could be that, though they've been on sale for 4 years now. So when's the right time to buy those? And bonds, same way. Those have gotten beaten up and now potentially we're getting some return out of those. So patience and process are very important with investing. But to your question about what does that mean for savers? Well, we had the discussion in our committee. We've been really riding our money market interest rates. We've been really big proponents of keeping your cash savings in high yield savings accounts. The yield on those, which moves as the Fed moves rates. If the Fed moves their short-term rates down, if they do cut rates in September, we'll see money markets and high yield savings accounts move down kind of in lockstep. But what this could be an opportunity if the market is kind of telegraphing that a rate cut is likely in September, it could be a good time for short-term savers to look at locking in some yields with things like CDs or treasuries, buy a year or two out because they're still pretty attractive. We're still looking at high 3%. Historically, that's pretty good on the short end of the curve. And we are seeing the curve start to steepen. And what I mean by that is we're getting a greater difference between the long end of the curve, the 15, 20, 30-year yields versus the short end of the curve, the 1, 2, 3-year yields. So it could be a good time for savers that don't need liquidity in the next year or two to eke out with some of their safe money a little bit more yield, where that could have been penalizing in years past because money markets have been so strong and taking the risk of that floating rate ended up getting you a little bit extra yield. But now could be a good time to lock in those short-term yields.
Yeah, and I just had a client in last week who was asking, how do I get more interest on my savings? I was getting used to that 5% number. Now I'm below 4 in some of my accounts. You might have to just be satisfied with just below 4, with that high 3% range on your CDs and treasuries rather than hold in cash. And quickly that could become, if the Fed has to accelerate those rate cuts, maybe the economy really slows down, those rates can go down to 1.5 or 2, so 3 might look pretty good in a year or two. It's kind of a hedge, right? A hedge against the risk that the Fed's going to be aggressive here. I would also note that as those rates have shifted down, that's true of the 10-year Treasury, which is correlated to mortgage rates. So those of you who have had mortgages the last couple of years, it may not be time yet, but start looking for those refinance opportunities if you've been in the housing kind of house shopping mode, especially those first-time home buyers, and home affordability has been a huge challenge. We're seeing prices drop in some key markets, including your hometown out in Phoenix and Scottsdale area. We're seeing now interest rates start to slide down. So maybe this opens up home ownership for more people as interest rates drop too. We'll see if that trend continues, if those rates keep sliding. But there's a lot that could move to the benefit of folks who need debt, maybe at the detriment of those savers, right? So there's gonna be winners and losers with the rate change.
Yeah, and for those that are thinking about locking in rates, even whether it's on the short end or the long end, being sensitive to the tax treatment of the different tools that you can use there, comparing the fully taxable yield on a CD versus the state tax-free yield on a treasury, or the federal tax-free on a municipal bond, which also could be state tax-free depending on which municipality you're in. Making sure that you're paying attention to what we call the tax equivalent yield. There's some great calculators online. So if you're going and you're doing some shopping by yourself, make sure you're understanding what the after-tax benefit is. It's not just that headline, hey, you can get 5% here. Well, yeah, but that's going to be fully taxable. So comparing that on an after-tax basis is important. Brian, anything else you'd add before we sign off today?
No, I think just a quick summary, pay attention to your cash, pay attention to your debt. That's always good, right? Be patient, be diversified here. I think that's crucial because there's a lot of uncertainty, and diversification is the way that we acknowledge that we don't know what the future holds. And then, stay close to your advisor. Make sure that they're helping you through all this. That's our joy to do that. But I'm always amazed how hesitant people are to ask for help in times like this that can be confusing and quickly changing. Yeah, we're here to walk alongside you.
Yeah, so thanks for joining us on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If you found today's conversation helpful, please like the video and go and subscribe to the channel and share this with someone who else might benefit. Don't be shy on that. So for more resources, you can also check out our insights page at johnmoore.com, and we'll look forward to seeing you next week.